So, like I promised you guys a continuation from the market structure series. Here on my chart, I have an annotation saying daily time frame consolidating, 4 hours bullish, 30-minute bullish, 15-minute bullish. The reason why I did stuff like this is to tell myself what I am actually trading, the market trend on each time frame. Just like we have 60 seconds make a minute, 60 minutes make an hour, 24 hours make a day, stuff, blah, blah, blah. Same goes on the chart because Forex is all about daily activities and each time frame, each minute, people are actually doing something. So one day we have two 30-minute time frame, four 15-minute time frame. It goes all and on, right? So you on a one daily candle, we can have a series of different trend on that time frame, right? So let me highlight this because this is very close, right? Let me highlight the two candles. Let's go on the 15-minute time frame and see what's happening there. You can see a market trend on that 15-minute time frame. This is a one daily candle from year to year. You can see Tuesday, September to Wednesday. We have a market trend. So you being a scalper, you can actually get more pips here. You can still sell again. So on a higher time frame, it's just like market summarizing what happened. On lower time frame, you can still have a market trend. So you can still be bullish on a higher time frame and still be bearish on the lower time frame. So the both people can be correct. So when people come online and say I am bearish on gold, maybe you're going to ask a question on which time frame. Maybe you're on bullish time frame. Sorry, you are bullish on higher time frame. And when somebody say I'm bearish on gold, you say, no, gold is buying. You are wrong. No, you can be right, and he's also right, or he or she is also right. Two people are right at the same time, right? So we have different type of traders: scalpers, day trade, swing, position traders. So it all depends on what you're trading. So on the daily time frame, you can be bullish. On 4 hours, you can still be bullish. On 30 minutes, you can be bearish. On 15 minutes, you can be bearish. On 1 minute, you can be bullish. It goes on and on, right? Just like I said, higher time frame summarize like the overall trend. Lower time frame tells what people are actually doing at that particular time, right? Because people are buying, people are selling. That is how you know on how to trade on each time frame because each time frame has a particular trend. So how to identify a trend? Remember I said on the previous video, bullish time frame is when market is going up, downtrend is when market is coming down, consolidating is when market or sideways pattern is when market is not trending at all, it's not going up, it's not going down, it's just on one particular place. How do you identify trend is first of all, you know your range. Range is consists on high and low. First of all, you mark your range, which is a market must have a high and a low, right? The first thing you mark for in everything that you're doing as a trader, know your range first, which is high and a low. So let's say market created a high here, yes, and a low. Let me bring this. Market creates a low and a high. Like this, we don't know what the market is actually doing. We only know the low and the high. So for us to be certain for a market trend is market need to break a low or a high to be certain that okay, we are actually on the trend now. So for me to be certain, market need to maybe respect this low and break a high, or market need to break this high, this low, sorry, and respect this high here. That's how you know a trend. So for it to be bullish, market need to respect a low, respect this low, then break this high. Now you can say this thing is bullish, but for we to be certain, market need to break at least two highs. So this is the first high. Then when price retrace comes down, then break another high again. Now we are not certain because why? We have two lows. This is a low, this is a higher low, this is a high, this is a high, this is a higher high. So we are now setting that okay, price is now on a bullish trend. So if you continue like this, I promise you, you're going to be like 60% in all your setup that you're going to be giving or you're going to be trading. So now you can now as well look for maybe a retracement in this particular range. Like I said, a range consists of a low and a high. So what you now do, like look for draw your Fibonacci from this low to this high, buy from the 50% discount. So continue the buy, blah blah blah. It goes on and on. Same thing goes with the what's it called? The bearish. We have a range. Price need to respect the high and break a low. Retrace. Now we are not. We price has broken too low. This low first and this second one. So for us to be setting, we'll draw a Fibonacci from the range, this and this. Then we sell down. So it goes on and on. So let's go on the live chat to explain what I just did. We have a range here, right? This is a low and this is a high. Price retraced, respected this low. Let me put the line. You can do all this thing on every time frame, still the same. It's all about market trend. Because always every trend market must have every time frame, I mean sorry, market must have a high and a low. So this is a low and this is a high. So price broke structure here. Now price retraced. Remember, we broken the first low. What happened again? Price went up, broke this high here again. So we have two highs that price has broken. That confirms the bullish trend. This is the second. This is the low that broke the high. So what happened? Price retraced again. I started buying. So let's say we draw a Fibonacci from this high to this high, and we bought from. Come here, I like to use 62%, and I'll give more space for the low. So this is how many risks to reward? 1 to 4. Something people can do 1 to 5, people can do 1 to 2, people do 1 to 3. It all depends, right? Same goes with the bearish trend. Like I said, once price break a structure, that's still like a new range, right? So every range, like I said, just look for the high and the low. That's when you know when market has changed structure. So this was the last this low and this high, but you cannot see it clearly. So let's use this one. This low and a high here. So now what happened? Price now broke this low, right? Now we now have a low that was broken. If you want to sell, fine by you. But I would like I said, I always like to wait for a second low to be broken to tell me that okay, now I'm on the bearish trend. What happened again? Like I said, we had a change of character here or a break of structure. So price now retrace, broke another low again, which is this one. So we have two lows that have been broken. This guy and this guy here. So draw your Fibonacci, blah blah blah. Sometimes price cannot retrace to your zone. But that's where fair value gap comes in. So price didn't get to the Fibonacci zone, which is the 50%. But that's where fair value gap comes in, which I'm going to be explaining in more videos to come. So stick around. So another thing I like to do, if I cannot find a trend, this thing, what I do is I will try to use line charts to tell me what I am doing. So now let's go back to the candle. Still didn't touch. For me, I would like to use fair value gap because why? This guy has mitigated this zone here. So left for me, I will cut this here. But that's a different topic aside. So let's say you cut this here. Like I said, price broke another low, right? Let's say you cut this your your stop loss should be few pips above the low. This is 1 to 6 weeks to reward. So you can get all of this stuff. You can catch different trades just knowing market structure. Like I said, first thing you identify the low and a high. Market must always have a low and a high on all time frames. This is a monthly time frame. Markets must have a low and a high, a low and a high, a low and a high. So different low and a high, multiple lows and a high is when you say higher highs and higher lows. Multiple lows and a high is when you see still lower highs and lower lows. When price breaks a high, that's when you know, okay, this one is now bullish. When price breaks a low, this is now bearish. So all you do is just identify. It's just as simple as ABC. Identify low and a high. When price breaks that high, then you now know, okay, this thing is going to form a bullish trend. When price breaks a low, then you know this thing is going to form a bearish trend. And how to clarify yourself is price breaks two lows or price breaks two highs. That's when you know market is on a bullish trend or a bearish trend. And when to know if market has changed character is once price keep breaking series of highs, we're on a bullish trend. When price now refuse to break highs and breaks low, then market has changed trend. Market was breaking highs, breaking high, breaking highs. Then when price breaks low, that's when you know has changed trend. It goes on and on. So in the next video, I'm going to talk about liquidity. So if I were you, I would stick around and try to understand how to be different from others, how to identify liquidities, because liquidities is what drives the market. Market is all about liquidities, where people are keeping their money. So do well to subscribe, like, share, comment, repost for other people to see this video, and also learn Forex. So yeah, see you on the next video. Stay safe and stay blessed.